Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, October 18, 2017. We're looking at a daily chart of the SPY, or Spiders, which is the proxy for the S&P 500. And at the expense of sounding like a broken record once again, I'm going to have to sound somewhat like a broken record. The market continues to grind a little bit higher each and every day, and it looks to me like we're still headed for the 256.57 level. Whether we get there or not at this point is almost irrelevant, being that today's high happened to be 255.95. I'm going to call that 256, and I'm going to call that within the margin of error. And if you remember, what we're discussing is the symmetrical move from down at this low up to this high. We had a little bit of a pullback and then an equidistant move up here. And to me, that looks like a symmetrical move. Whether or not it completes for another 50 cents or not is really irrelevant. To me, it's complete. Now, this doesn't necessarily mean that the market cannot continue to grind higher. It certainly can continue to grind higher. We're above all the moving averages. The moving averages are creeping up each and every day, and therefore the market can have higher prices ahead of us. I just don't necessarily think it's the most probable call right now. I think that obviously we have been due for a pullback, but we are due for a pullback. I mean, it's getting really, really long in the tooth. The market has extremely light volume. If you look at the volume today, it's 37 million shares. We're still settling out. I'm making this video shortly after the close today, and there'll be slightly more volume that comes in over the next couple of minutes. But, I mean, it's getting to the almost silly point where we need a pullback. It's just enough already, and it's got to be upon us at some point in time. Doesn't have to happen. I just think it will happen. Tomorrow happens to be the anniversary, the 30-year anniversary of the 1987 stock market crash. The issue is that the media on all across the board, all media across the board has been plastering that for the last day or so, and therefore the more they talk about it, the less likely something material is to take place. Maybe we have a little bit of a scare in the morning and they begin to talk about it more and more, but for any kind of a meaningful, I'm not expecting a crash, by the way. That's not what I'm saying. I never was expecting that. I'm just expecting some kind of a pullback to happen at some point in time, and the only way we're going to know that is happening is to get a high volume reversal day. That's the only way that we're going to be able to say, here comes a pullback, this was a reversal day, and we go on from there. We haven't seen anything remotely close to a reversal day, so until and unless that happens, the market continues to grind higher up until the point in which we do see that kind of an event take place. We're going to move it along to the IWM, and in the IWM, we saw it pull back in a bullish formation for the last several trading days, really about the last 2 weeks of trading. And yesterday we discussed the fact that the 148.08 level was coming close. Yesterday's low happened to be 148.50. And today, miraculously, we have an up day of about 74 cents, and we're trading away from, in the upward direction, the 148.08. That still remains the important level. That level will be more important, or close to that level, will be more important at the end of the month to see if we close the month once again above the upsloping trend line that's been intact since 2011. But you can see what happens. The markets like to come back to test the lows of green candles and the highs of red candles. And yesterday, not that we came down to the low of the green candle, but we got pretty close compared to where we were just, a week and a half earlier, all the way up here at 150.68. And yesterday we came down to a low of 148, 148.50. And today we had a decent up day, up 0.5% in the IWM. Again, this is a bullish pattern. Generally speaking, this pattern is going to promote higher prices ahead, although bullish patterns can fail at highs, bearish patterns can fail at lows. In fact, these patterns can fail at any point in time. We just go with the probabilities, and the probabilities are that this pattern generates higher prices And until and unless proven otherwise, that's what the pattern says we expect. Let's go over to the transports. And again, same routine in the transports. Yesterday, the day before, and the day before that, we had down days in the transports. We closed below the 20-period moving average yesterday, and what happens today? We have an up day, up 75 points, 0.75%, and we finish back above the 20-period moving average. Which one is it? Meaning, which one is the real close? Was it yesterday or was it today? Well, we're going to need another day or so to see how that pans out. The market's playing games with everybody. It's making it very difficult to get a read. We have light volume across the board. The market is lulling everybody into a false sense of security. It's in sleeper mode, and we just have to wait for the market to give us the solid indication of what the next likely move is. And each and every time, I think I have the beat on something. The IWM's coming down. The transports are coming down. They look like they're the canaries in the coal mine. And then today, we have an up day in both markets. It's just interesting to say the least. Just when we think we have some divergences at hand that we can read into, they reverse trend, go the other direction, and everything was up across the board today. Some of the markets up more than others. We know the Dow was up 160 points. Most of that was as a result of the big push forward in IBM. They reported earnings yesterday. The market liked it, and it sent IBM up markedly all day long. IBM was up about $13. When's the last time you saw IBM up $13? And I'll give you a clue as to why that is. Part of that was short covering. IBM has missed their earnings number for the last, I don't know how many quarters in a row. And each and every time they miss, they send the stock lower. Well, this time, I don't know whether they missed or they didn't miss or whatever it was. I think they still had a drawdown in their total revenue. And so they've had declining revenue quarter over quarter over quarter for a long, long time. But the point is that it's also options expiration week. And during the week of options expiration, it's not uncommon for stocks that are down into their earnings to pop up and stocks that are up into their earnings to drop lower. It's the way the options desks, the institutional options traders, make their money. This is the week, each and every month, that they make their money for the entire month. I didn't look, but if I had to take a guess, I would imagine there were a lot of people holding puts into the IBM earnings. They had to cover those positions. If they had short positions just on the stock alone, they had to cover those positions. And what happens when that takes place is you get a lot of buying, and then you get panic buying, and it sends the stock up like IBM up $13. It's not a stock that will typically move $13 in one trading session. I attribute a lot of that due to options expiration week. Moving over to the gold market, gold came down to a low today of $1,278 spot 60. It pierced through the 100-period moving average, bounced off that, and right now is trading at 1282 spot 60. And therefore, we still have remaining the gap fill area at 1274 spot 90. We didn't fill that gap yet. That doesn't mean we can't. We just got supported by the 100-period moving average so far. Doesn't mean it can't come back down. In fact, I think it will come back down. It just may have to tread sideways for a while. Maybe it gets a better bounce off the 100-period moving average. Ultimately, this gap will be filled. Whether or not it happens on this move, well, we'll see over the next day or so. We got pretty close. We got into the zone that we discussed last night. We discussed that we were in the zone anywhere in this neighborhood below 1280 all the way down to 1275, or the gap fill officially at 1274 spot 90, maybe even a little lower. So we got into the zone and we found a little bit of intraday support. We'll see what happens over the next day or so, but certainly gold came down to the area that was expected. Silver chart looks much of the same routine, again supported by the convergence of the 120-period moving averages. We bounced off that today, but it looks very much the same. Gold and silver are trading for the most part in tandem each and every day for the time being. I think there's lower prices ahead for both gold and silver, at least a little bit lower from where we went, but we certainly got supported by the 100-period moving average in both these markets. But they did pretty much what we thought they'd do, from the top up here at 1750 Also, the bottom down here at 1640. I still think they're going to come down a little bit lower. Silver down in this area. Gold also a little bit lower to fill that gap eventually. Crude oil continues to creep higher, continues to creep. And this, by the way, we've rolled to the next contract month in crude oil. We were on November. Now we're on the Z contract, or December, in crude oil. And what's interesting is when you roll to the next contract month, I haven't moved this line, and I need to move that line. But what's interesting is now all of a sudden it shows that on the 16th of October, we touched that line, which didn't show the same in November. I just think that's a little bit of irony. It's interesting to say the least. It just doesn't mean anything, certainly of a material nature. So if we move the trend line, and what I've done is I've connected this low, and here's your trend line, and you can see here, we hit it here, and we haven't hit it, and this now looks like the November contract looked before. But again, if we continue to at least go sideways here for another few days, that would be the market's way of building some energy to challenge this pivot high. We don't really need this trend line anymore. What we're concerned with is this pivot high here, and if we get above that pivot high, then you'll see the crude oil market head to $54, and it usually moves in $1 increments, 50 cents and then $1. So 53 or just slightly above 53, this pivot high actually comes in at 53.09. We backed off, we pulled back, built some energy, and now it looks like they want to make a run for higher prices. We'll see if that's the case or not, or do we get rejected once again right above the 53 level at this pivot high. If we close above this pivot high, then 54 is in the cards, and then up to 55 in this neighborhood of the most recent highs that come in. In fact, the actual high that I've got my eye on is all the way up at 55.92. I don't necessarily think we're going to get there on this run. I'm just suggesting that if we close above the 53.09 area, then 54 is in the cards. That's it. Looking over at the bond market, we talked about this bearish pattern. We made a run for the red candle high. We didn't quite get there. We got stymied by the 50-period moving average, and you can see the market was rejected. However, we're in the last green candle. We're still above the low of that green candle. We came down today to challenge that, but we're above there as we speak, above the low of this last green candle. I'll point it out with a line here, and you can see here this green candle. We're above that now, and whether or not we continue higher remains to be seen. Technically speaking, as long as we stay below the high of this red candle, this breakdown candle, this is a bearish pattern that should promote lower prices. But the fact that we've had a pretty decent rally off this pivot low that was made on the 6th of October, if we do come down again, I'm not so sure that we're going to be supported by the last level I thought we'd be supported again by, which was these pivot lows down here. The fact that we've kind of taken a deep breath, right? We made a low, the market took a deep breath, it built some energy, and if we come down with any kind of velocity, I'm not so sure that these pivot lows over here are going to hold, and we might look for lower prices. That's a long way off right now. We'll just see how the bond market trades out over the next few days. And the last market we'll look at tonight is the dollar. And the dollar, same routine. It looks like it wants to go for, again, the 100-period moving average and that elusive 93.835. Again, I'm not 100% convinced the low is in the dollar. I'm going to wait again for the weekly close. And just as a refresher, the weekly close is going to be important. If we close above the 200-period moving average, it's going to tell me the market's trying to consolidate for higher prices. If we close below, and this is Friday's close, if we close below the 200-week moving average, it's going to tell me that this was just a dead cat bounce and we're most likely failing and lower prices are coming. And I'm going to reserve any further commentary for Friday's close in the dollar, as it is somewhat of a tricky chart to read right now. I'd rather just go with the weekly closes for the time being, and we'll leave it at that. And with that, it's everything I intended to discuss tonight. So I'm going to wrap it here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.